One of the challenges many traders face is picking the right time frames. In this video, I'm going to walk you through different time frames and the types of traders who use them, so you can decide which ones are best for your trading style. We're going to start from the very first type of trader all the way to the last, so make sure you watch this video till the end to find out which category you fall into. Okay, we're going to start with position traders. Position traders are traders that can hold their trades. These people can hold their trades for 3 months, for 6 months, even up to a year. Okay, the time frames these position traders used are, they use the monthly time frame as their higher time frame. This is the time frame they use to anticipate a draw on liquidity or where price may likely reach for. Okay, then they use the weekly time frame for their analysis. This middle time frame is where they use for their analysis. This is where they map out a break of structure, a change of character. They also use this time frame to identify, let's say, an order block or a fair value gap and all of that, right? When once they spot an opportunity on the weekly time frame, they will go down to the daily time frame to pick an entry. So daily time frame is their entry time frame. For example, they spotted a fair value gap on the weekly time frame, they will go down to the daily time frame to pick an entry based on what they've spotted on this time frame. If you want to consider this style of trading, you need to ask yourself some questions. Am I a patient trader? Can I hold my trades for months even when price is in a drawdown? Can I hold my trades? The next thing you need to consider is, do I have enough capital to hold my trades for as long as? If you don't have enough capital to hold your trades, and if you're not patient, if you know you're not patient enough to hold your trades for weeks, for months, for like months, then position trading style is not for you. Let's go into the next type of traders. We have this category of traders called swing traders. I have two type of swing traders here. I'm going to start with the first type of swing traders, then we talk about the second type of swing traders. Swing traders are people that can hold their trades for like weeks, right? They can hold their trades for weeks, they can hold their trades for days. In as much as price has not hit their TP or their SL, they're ready to hold their trades. So people like that falls under this category. They can hold their trades overnight. Okay, so they use the weekly time frame as their higher time frame where they anticipate price to reach for. Then they use the daily time frame for their analysis. Daily time frame is where they map out a break of structure, a change of character, where they also spot their points of interest, for example, a fair value gap or an order block. So when they've spotted a fair value gap or an order block on the daily time frame, they will wait for price to come to that their point of interest. When price is in that their point of interest, they will go down to H4. So H4 now is their entry time frame. This time frame is where they pick their entries. So once they spotted, for example, a fair value gap on daily time frame, when price gets to that point, they will go down to H4 and pick an entry on that point of interest they spotted on this time frame. Then where they place their stop loss, they are going to use this H4 to anticipate where they will place their stop loss and where they will also place their take profit. If you want to use H4 as your entry time frame, do you have enough money? Do you have enough capital to hold your trades even when price is not going as planned, even when price is approaching your stop loss, right? If price hits your stop loss, will you blow your account? That's another thing you need to put into consideration. If you don't have enough capital to hold trades as a swing trader, then this type of trading is not for you. Alright, okay, so let's go into another type of swing traders. Remember, swing traders are traders that can hold their trades overnight. So they can hold their trades for days, they can even hold their trade for a week or more. This category of swing traders uses weekly time frame as their higher time frame. And this is where they anticipate a draw on liquidity. These swing traders also use the daily time frame to map out a break of structure, a change of character. They also use the daily time frame to spot, for example, a fair value gap. So when price gets to that their fair value gap they spotted on the daily time frame, they will go down to H1. H1 is where they want to see an entry signature based on what they spotted on this daily time frame, for example, a fair value gap. So we want, say for example, let's say they want to see a shift in market structure on that fair value gap. So when once price gets to when once price gives them a shift in market structure based on the fair value gap they've spotted here, and the price retraces a little to that point, they'll pick an entry. They'll pick an entry, place their stop loss, and place their take profit. So this is their entry time frame. If you think you can't handle using H4 as your entry time frame, as a swing trader, you can also consider using H1 as your entry time frame. Okay, so remember, the one that works best for you is what you use. At the end of the day, trading is personal. Okay, away from that, then let's go into the next category of traders. We have day traders. I also categorize day traders into two. We have this first one that we are going to talk about, that we're also going to talk about the second type of day traders. First, who are day traders? Day traders are people that do not hold their trades overnight. So once they pick a trade, they must make sure they close their trades that same day. They don't leave their trade overnight. These people use the daily time frame as their higher time frame, where they anticipate price to reach for, like they have like daily bias. If, for example, daily bias is bullish, so I'm going to look for entries based on that daily bias, like bullish opportunity. All right, then they use H4 as their analysis time frame. So this is where they map out a break of structure, a change of character. They also use this time frame to identify, for example, a fair value gap or an order block, right? So when once price gets to that fair value gap or an order block they've spotted as their points of interest, they will go down to M15, right? So when they get to M15, they want to see a confirmatory signature on that fair value gap or order block they've spotted on H4 to pick an entry from. So for example, they want to see a shift in market structure based on the order block or a fair value gap they spotted on this time frame, right? So when price gives them like a shift in market structure on that their point of interest, they'll look for opportunity and trade. Let's say price is trading to the downside, they'll place their stop loss and their take profit on this M15 and hold their trades for price to get to either their TP or their SL. Okay, so these people do not really need enough capital to hold their trades compared to these ones, right? If you don't really have enough capital, you can consider being a day trader. The time you have to look at your chart is something you also need to put into consideration. Okay, then we have these other day traders. This type of day traders do not use M15 as their entry time frame. They use the daily time frame as their higher time frame, where they anticipate where price will reach for. Then they use H1 as their analysis time frame, where they map out a break of structure, change of character, a fair value gap, and order block, and all of those stuff. So when once they see, for example, a fair value gap on H1, they'll go down to M15. Going down to M15, they want to see maybe a shift in market structure based on that fair value gap they have spotted on H1. So once they see maybe a shift in market structure, they will go ahead and pick an entry on this M5, which is 5-minute time frame, place their stop loss and place their take profits. People that think they can use M5 5-minute time frame as their entry, that 5-minute time frame is too noisy, they can as well use 15-minute time frame as their entry. Okay, so it boils down to what works for you. What works for you is what you stick to. So we have the last type of traders called scalpers. I also put scalpers into two categories. These scalpers are people that do not really hold their trades. They go for few candles, like 1 or 2 candles that is pushing to the upside or pushing to where they are anticipating price to reach for. Once 2 or 3 candles closes, they will just collapse their trade. They don't hold their trades for a long time. So these people can pick like 5 or 6 trades in a day. Okay, so they just go for few moves and they are good to go. They will just collapse their trade and look for another opportunity. H1 is where they anticipate price to reach for. Let's say they've identified a candle on H1 that the candle is pushing to the upside. Do you get? So they're like, okay, I'm going to pick a buy, right, on the lower time frame. The next candle that is pushing to the upside is what I'm going to trade. So they will use M15 as their analysis time frame, where they map out a break of structure, change of character. Maybe when they spot like a fair value gap or an order block on this M15, they will go down to 1 minute time frame to pick an entry based on what they've spotted on M15. Okay, Then we also have these other scalpers. They don't use 1 hour time frame as their higher time frame. Rather, they concentrate on 15 minutes time frame, right, as their higher time frame. So they will use M5 for their analysis where they map out a break of structure, if favorably gap or whatever. Once they spot a favorably gap or other block based on their entry criteria on M5, they will go down to 1 minute time frame to pick an entry. Okay, so these people hold their trade for just a few pips and they are good to go. I have to say this, even when you choose your style of trading, you still need to make reference to these time frames to know where price will reach for. Do you get? It does not necessarily mean you have to be trading on this time frame, but you just need to know what the higher time frame is doing, like the daily time frame. You need to know what the daily time frame is doing. You also need to know what the weekly time frame is doing. It's not like you're going to be looking at the weekly time frame every single day or every single minute or every single hour. You are just anticipating where price will reach for on the weekly. You're also anticipating where price will reach for on the daily time frame. Let's say you want to start your analysis for a fresh week. You want to look at the weekly time frame. How did the weekly candle close? Where do I think the next weekly candle will push to? Is it going to push to the upside or is it going to push to the downside? That's the only thing you want to know about the weekly candle, even when you're a day trader or you're a scalper. Then for the daily time frame, if you are coming into the market the next day to look for opportunity, you will still need to make reference to the daily time frame. So even as a day trader, like I said, you still need to look at the higher time frame because the higher time frame controls what happens on the lower time frame. It does not necessarily mean you have to use the higher time frame for your entry or for your analysis just to anticipate where price will reach for. Do you get? So I hope this video was helpful. If you're new to my channel, please consider subscribing and like the video. Thank you so much for watching. See you in my next one.